Welcome, everyone. Great to have you here. I'm your host, Jason Nadek. Think back to the spring and summer of 2020 for a moment. It was the depths of the market crash sparked by a global pandemic. Many businesses struggled to adjust to the new normal, as did their share prices. But one sector thrived through the turmoil. It was the technology sector. Consider the NASDAQ 100 index, which tracks the largest tech stocks on the NASDAQ exchange. It roughly doubled from March 2020 to its high that it reached in November 2021. That crushed the performance of the S&P 500 index ETF, which rose by about 55% over the same time frame. And it continued the tech sector's outperformance of the broader market since the 2008 financial crisis. This all may have had some investors feeling as though technology stocks were unshakable, but that's not how things played out. A wider market sell-off took place during the first half of 2022, and technology stocks were among those that tumbled the most. Some investors may wonder whether the golden era for tech stocks might be over, or if there's a buying opportunity to be had. We're going to get some perspective from Vitali Mossounov. He's Vice President, Director, and Global Technology Analyst at TD Asset Management. Vitali will explain what's behind the drop in tech stocks and some factors that may help you identify undervalued tech stocks amid all the market volatility. Vitali, thanks so much for joining us today.
Fantastic to be here. Thanks for the invitation, Jason.
Yes, it's my pleasure. Could you maybe give us a really quick overview of kind of what you do?
Yeah, of course. Every day I get behind a computer and read. That's a big portion of what I do and what all the analysts on the team are engaged in doing. But really, it's my job to be an expert in the majority of the tech sector for North America, Western Europe, and other major markets. And ultimately understanding the businesses that are investable for our clients as we make investment decisions, understanding not only the fundamentals, the strategy, the track record, having a good understanding of management, many other aspects, and ultimately coming to a decision, a conclusion, and a recommendation, and a forecast, how that business will do over the future, and then deciding whether those securities are suitable for our clients.
Absolutely. And one quick thing, and the word panic in the market is not something that we take lightly, but maybe retail investors that might be more easily to succumb to emotions. But I'm just curious about somebody, maybe a professional in the industry. How does that work for you, like that intensity of the everyday market?
It's we're all human beings, and it's something all of us think about and try to fight that instinct of emotion. And I think in a professional setting, there is no room for panic, and there is a lot of training and thought we put into controlling those strong emotions, because I think there's abundant evidence to show that they don't lead to good investment outcomes. So one of the rules, I think, is that whatever the news is that's causing that sharp emotional response from an individual, in a professional setting, investors almost never act on that immediately. Whereas I think in more of a retail setting, there is that propensity to go and act and click a button and take action. The professional setting, we have the advantage of time and resources, being able to get deeper into the information that we have all day. It's what we do for a living, follow up with the company, speak to other experts. And so, they say sometimes when you get angry about something, not to tell that other person what you're thinking, but to take 10 deep breaths or whatever it may be. And so I think in the professional setting, we have that benefit of time, which heals all wounds and leads to better decision making.
Great. Okay, so before we dive into our conversation here, I have a quick trivia question for the audience. All right, so the question is, how many technology companies are among the 10 largest by market cap in the S&P 500 as of the end of June 2022? So stay tuned to the end of our interview, and I'll show you the answer. Okay, Vitali, let's talk tech. Some investors worry that the sell-off in technology stocks that we saw in the first half of the year could be akin to the dotcom sell-off back in 2000. What do you think about that comparison?
Well, there's certain similarities that exist for sure, and I think those similarities are best summarized by emotion and hype. in that stocks went up an awful lot in that period of, well, really 98, 99, and the early part of 2000. And you had a similar phenomenon unfold also, in particular around technology stocks through the course of 2020 and the majority of 2021. I think that on a fundamental level, though, if we separate ourselves from the charts, which again have some similarities, the fundamentals underlying these businesses are particularly different. We've gone and studied that period of 99 and 2000, and it varies, but generally speaking, there were an awful lot of companies that had very little revenue, no earnings, and were really, you could say, seducing investors on the promise of a bright future for a product that may not even exist, or a product that only had eyeballs or clicks. And so it was a very nascent time for the internet. I actually would draw an analogy not to the technology sector of today, but the technology sector back then was very much what the blockchain ecosystem was during this period of 2020, 21. So it was a nascent time for an exciting technology. Investors got behind it, but 20 years later, if you look at the technology sector, this is a different sector. This is a sector with, first of all, it's underpinned by mega cap tech companies that dominate the lives of consumers, enterprises, and industries with very real products. Of course, I'm talking about the Apples and the Microsofts and the Alphabets, the businesses at reasonable valuations, multi-billion, multi-$100 billion revenue and free cash flow streams, deep entrenchment into our lives. And so we're no longer in the hype cycle of the internet and technology as we were 20 years ago. It's a maturing industry with real businesses. And so I would say if you're going to draw parallels again from the late 90s to today of 20 years later, I would focus on the blockchain industry more than anything.
Some investors are wondering if the technology sector is overvalued, undervalued, or somewhere maybe in between after the sell-off in the first half of the year. What does the data tell us based on the valuations we've seen in the past?
The data tells us that technology valuations are historically higher than that of the overall market. So what we can look at is simply the PE ratio of technology stocks, the entire sector, and divide that by the PE ratio for the S&P 500, which we'll call the market. And what we would see is that over the last 30 years or so, typically, technology companies would trade at a premium. They would trade at a premium for a reason. We can talk about that in a few minutes probably. But what we're seeing today is that that premium, which has been at times zero, at times it has been 100%. The 2000 bubble, which we spoke about, that's what the premium rose to at that time, 100% premium, paying double as much as an ordinary share of a general company. Today, that premium, after rising to about 45-50% during the height of COVID, has returned to near its historical average at 20%. So according to this analysis, and of course this is only one tool to employ, this is telling you that technology companies are neither too expensive nor too cheap relative to history.
Okay. Now, many tech stocks have declined significantly, as we've covered through this conversation already, from their highs later in 2021. But their underlying business might still be strong. So let's get into some factors you believe may help investors find high quality tech stocks. The first factor is if the company's products and services address a large market of customers. And what is a large addressable market in your opinion, and why is this so important?
This is going back to our emotional, psychological conversation that we started off with, Jason. And this is a sector for storytellers and narrative, and it's going to attract enthusiasm, and enthusiasm is going to attract money and higher valuations. Whenever something is valued at a high level, we need to make sure that that's appropriate. And one way to make sure that's appropriate is to make sure that this product that's being presented as something extraordinary has enough potential users, a large enough addressable market, so that the company can grow into its valuation, and of course, so that the valuation can expand. After all, we're looking for our investments to grow. We can pick on the case of Apple. Apple has, of course, proven that the market is large enough. A billion or so users of an iPhone, each phone at about $1,000, and all the other services they can sell on top of it. That has supported a market cap that at times has been north of $2 trillion. And so that's, of course, made for a phenomenal investment for people had they made that in the early days, 2012, 2013, 2014. That's an example of an addressable market where you would have done your work and come to the conclusion that it's large enough to support this wonderful story that Apple was telling. But there are many exceptions, and from time to time, what we'll see is a company with an amazing story. And if only because we've already established this thread, I'll go back to the example of blockchain. But we've met many of these companies that were doing really interesting things technologically, but a multitude of them would come to the public markets and say that this is the solution that I have, and you would struggle to get an understanding of how the market was big enough. Meaning, how can there may not be enough people that are interested in this product at a price that supports the current valuation. So big returns in technology and good returns in technology over the long run are going to be coming from companies where there's a very large addressable market to support the growth.
We often hear having a wide economic moat is preferable to business in general. How significant is it in the technology sector? And what might give a company a wide moat?
If you're indeed investing in businesses, you are buying, when push comes to shove, you're buying the stream of future free cash flow discounted at some rate. And future free cash flows will only exist if that business continues to do well. And so thinking about moats, what prevents, call it invading forces from taking your business, and everyone's trying in an ultra-competitive world, more than ever in a globalized ultra-competitive world, is critical. So that preamble is only to say, get to the chapter on moats, and whatever business you own, technology or a grocery store, figure out why it'll be around in 20 years, because you need to support that valuation. Now, when it comes to technology and the moats that we typically see, or that investors want to see, surprise, surprise, a technological moat would be something that would be preferable. Typically, we are speaking about businesses that are in the high-tech industry, and intellectual property that is either protected by patents or internal know-how and manufacturing and research expertise is extremely important. This is particularly true for the semiconductor industry, where companies that thrive typically have a proprietary process or product that is very difficult or impossible for others to replicate. That's number one. A lot of technology companies exhibit what we would call the competitive advantage of learning. And what I mean by that is, if you now look at the space for enterprise software, the businesses, the likes of Microsoft or Oracle, we use Salesforce and all of these other products, Adobe, you're really now banking on a very sticky customer base that is loyal to your product and has very high switching costs. And so even if a competitor product was to offer a lower rate, a lower price, or equal functionality, very few people are likely to switch because it took them a long time to master their product. And so even for something as simple as Microsoft Word, as we've all noticed in Excel and all this stuff, it stays because there's no reason for anybody to switch a word processor or spreadsheet tool. So those are, I would say, two key things that we need to keep an eye on in technology and serve as typical moats.
Now, your second factor for finding high quality tech stocks is if the company's technology is mature enough to be commercialized. What do you mean by that?
One of the things that is dangerous is to go and look at a whole bunch of small cap technology stocks, and some of them will have markets that are large enough that they could address. But no one says that you can only be a publicly traded company when you have a great product. And so what you see sometimes is technology companies that become publicly listed, with a great story that the analyst can read the whole book and say, this is a big enough addressable market. But the problem is that that company hasn't reached critical mass, hasn't reached a sufficient level of development and commercialization of their product. And so investors that I think often make the mistake of pursuing those kinds of stories are taking on a disproportionate amount of risk. They're really acting as almost a venture capitalist in the public market. That is really not the intent of those investors. They get fooled into doing this. And then more often than not, then that product isn't the one that actually hits the proverbial jackpot, because there's just too much competition and too many factors. I'll just give you a practical example. If we were to look at, really, we'll just call it virtual reality. And I think that's going to be a massive medium for consumer computing. And so if that was a standalone hypothetical company, you would look at that and you would say, oh my gosh, yes, probably the market for these devices would be at least the size of the smartphone market. And we've seen the size of the smartphone market has been large enough to support the world's largest company, Apple. But where that would fall apart, and this hypothetical example, is the level of commercialization for something like VR, right? There's a few million units shipped every year. The killer app has not yet been realized. Everyone's piling a lot of money into it. But really, at this stage, that would be a story that would fall apart at that stage of analyzing commercial fit, because there's still too many factors. It could be Apple's working on a competitive device, so is Sony. We don't really know what form it'll take. And so this company behind the scenes is making so many decisions, and there's so many variables that they can't control, that it would be really easy to sort of mess up that investment lens. So commercialization of product, very, very important.
Absolutely. They need to make money somehow, right?
Yeah, well said.
So another factor on your list for potential strong investments is investment efficiency. Why is this important, and how can investors identify if the company has this potential?
There's a number of ways to do this, but one way investors could look at this is to say, this company in, let's say, 2021 spent $1 billion on research and development, sales and marketing, and other OPEX. And so they spent $1 billion really building their products, building the future of their product, the development of it, and paying salespeople to distribute it and advertise it and so on. Look at the mathematics, look at the financial statements, and ask yourself, in the following year, what increase in sales did that $1 billion of sales generate? And at the end of the day, if a company went and spent $1 billion in operating costs and they didn't grow the year after, that is, no matter what management says, that is a question. Why did you spend all this money? Where did it go? And why wasn't there a return on it? And you can do this exercise across a universe of companies, and then rank them, and find the most efficient companies with the best unit economics. This is a very preliminary exercise, but I find it's extremely helpful at weeding out the best companies from the worst. And in the best case, you will see that those numbers come to the surface. Those companies come to the surface, where you'll see, no doubt, a company that may have spent $100 million that the next year saw a couple $100 million of sales increases, and you'll have to do more work and read what happened exactly. But you would look at that and you would say, this is a company that spends money to acquire revenue, and they do it better than anyone. And then the next question to ask is, what is the nature of the revenue that they just acquired? And so the second piece to that is to understand the business model. Is this something that's a one-time sale, or is this something that's a recurring revenue business? Meaning, is this a one-time sale of a hardware device like an iPad, in which case the company really shouldn't spend much to get that consumer, because that's a one-time sale? Or if this is the case of a software company, then it's okay to a greater degree, because you can pay $1,000 to get $1,000 if that $1,000 is something that users pay every single year for the next 10 years with no incremental acquisition costs. So some of the things to consider, but really it's how much are you paying to get that next user or sell your product. Companies need to make money. Everything is a DCF at the end of the day. And there are a lot of stories that come in public markets, good storytellers, that have companies with bad unit economics that essentially lose money on every product that they sell and always will. And do you know what those companies are worth? Zero. They're not worth anything because they'll never make money. And so that investment discipline of understanding if a company is losing money, which of course a lot of companies in tech are, if they are losing money, we better understand what the path is to making money, and we better see why it is that they're losing money today and that they're not just buying business.
All right, so we've covered some qualitative factors that indicate a compelling story that a technology company may be looking to tell. Now let's get into some hard numbers to see what a strong tech company might look like under the hood. What are some of those fundamental metrics that you're looking to see?
Well, I like to see a few things. I like to see revenue growth first and foremost. At the end of the day, companies need to grow. I mean, there's different styles of investing, but the world is growing. Progress is the name of the game in technology. And so I like to see growth. I like to see growth for successful technology companies that's some reasonable multiple of GDP. If we think of GDP typically being 2-3% in normal times, seeing a technology company grow their sales at a rate of 2-3 times GDP, call it 10%, is a great sign that this is a business that is making a product, whatever it may be, that the public, whoever that may be, wants, and that it's either capturing a new market, it's expanding its penetration into and share of the wallet, whatever it may be. That's additional work we have to do. But revenue growth is a good starting point. That revenue growth, then we've alluded to this because we've spoken about unit economics, but we'd like for that revenue growth to be coming from a product that is defensible. I suppose that was our moats discussion. And I think looking at a company's gross margin is typically a good heuristic. Just a reminder, of course, gross margin is your revenue minus your cost of goods sold. Businesses have gross margins ranging in everything from zero or negative, I've seen, all the way to 90+%. And the higher your gross margin, the more dollars you have to work with for your operating expenses that could go ultimately to shareholders at the end of the day. But I think equally important is higher gross margin is typically a sign that your product and your business has a larger moat around it. So if I can manufacture something for $2 and sell it for 10 and capture that whole value, well, I think there's probably something special there because competition is not coming in and knocking you down. Whereas, of course, a generic product, we see that with PCs and other computer components, the margins could be razor thin as everybody rushes in and replicates it. So I think gross margins over 50% is another heuristic that's very helpful. Finally, or I suppose third out of, I'll give you 4 factors, as we go down the income statement, I look, and really let's transition into the cash flow statement, but look for operating profits or the free cash flow margin to be in a healthy range, 15-20% plus, meaning the company's translating its strong market position that it has with revenue growth, and in a higher gross margin, a competitive advantage. It's translating that. It's not overspending. It's not buying revenue. It's actually translating that into real profits that can go back to us, to investors, that we can actually discount as part of our valuation. And so 15-20% plus free cash flow margins, that's the kind of level you see from these best of breed companies like Microsoft historically and other businesses. And so that's a good sign to see. And then finally, I suppose this is the one that goes to unit economics. You can probably readily pull this up, but return on invested capital is an important metric. Ultimately, management teams will talk about their capital allocation, taking money, plowing it into the business, and ultimately the question is, if you're going to be putting money into the business, what kind of return are you getting on it? If you're getting a bad return on it, don't do that. Give me, the shareholder, back the money. Buy back stock or pay dividends. So it's very important to hold management accountable. Look for return on invested capital higher than the cost of capital, ideally higher than 10%. That is a good sign that management, you have the right management at the helm, and they're taking the money that we've given them as investors, and they've put it into productive uses with the investments that they're making.
Okay, I'm just going to take a quick pause here before we jump to the next question because you've given us a lot of useful information. And I don't want it to be overwhelming for the audience. So I want to show you how WebBroker can be a useful tool to track down and help you start to accumulate all of this information. The WebBroker stocks overview page is much, much more than just the last traded price of a particular stock. On this page, you get access to a wide variety of useful information, from charts and news to independent third-party research reports to analyst projections. Let's start by looking at some of the fundamental data that's available here. It can be located by selecting the Fundamentals tab, fourth from the left, just beneath the stock quote. From here, we now have access to a significant amount of financial data from the company, such as earnings per share, price to earnings, return on investment, and many, many more. These fundamentals are compared to the industry average, and a synopsis is provided on the right-hand side. Beyond comparing the company to the industry, you also have the opportunity to compare that company to its closest competitors by choosing the peer comparison tab from the top of the page. Lastly, the Fundamentals tab offers you access to the company's financial statements, where you gain access to seeing their income statement, their balance sheet, as well as their cash flow statement. WebBroker has provided the tools to do your own fundamental analysis, but you also have the opportunity to compare your findings and hear the insights of independent third-party analysts. That information is found by selecting the Reports tab from the top of the page. There are clearly a lot of reports to take in, but one that I'd like to highlight is the Morningstar Analyst Reports. It can be located by scrolling down on the right-hand side. This report offers insight on many financial metrics we've discussed here today, comparisons to key industry players, and a competitive analysis on economic moats. Beyond the fundamental research and analysis, if you're looking for price projections and stock ratings, WebBroker offers a comprehensive collection found by selecting the Analyst tab from the top of the screen. On this page, you gain access to historic as well as future price projections to help inform your investment decisions. The consensus of the analyst opinions is located on the right-hand side, but you also have a chance to scroll down and look at the analysts individually. Here, we can see when the analyst last updated their opinion, their rating, their last action, as well as their price projection on the right-hand side. All right, now, many investors look to valuation metrics such as price to earnings ratio to help them gauge whether a stock is undervalued or overvalued. But you say valuations aren't quite as straightforward as that with tech stocks. Why might that be?
Well, let's start, Jason, with the point that valuations always matter, and there are various tools that investors can employ in their valuation toolkit. The tool that we often use, a P ratio, is not quite applicable because you could say that the earnings are understated in a growth phase for the business, and so for that reason, technology becomes a little more complicated. Now, what that doesn't mean is that you stop valuing the company and revert back to evaluating just the story, right? Just the storytelling, just the narrative. That's where you get in trouble. That's where I think investors at times got in trouble in the last 2 years. So just because the ratio doesn't apply doesn't mean that you drop all due diligence on valuation. That would not be correct. For us, that due diligence, a lot of it comes from a classical discounted cash flow valuation, being able to model out the company for 10, 20 years and finding out some reasonable terminal value, but really getting a sense of you're reinvesting in the business today. You may not have profits. Tell us about how much you're spending to get a customer. Tell us about your capital allocation strategy. Tell us about your terminal profit margins. If you're not profitable today, when do you hope to be profitable? And what will be the changes in your operating environment, your market, your customer demand for your product that will lead to those outcomes? So that and taking those results, discounting it, gives us a sanity check, really, of whether a stock is really just overhyped on narrative and can never ever revalue it appropriately, or if management has a point here, it's investing correctly, and there is value even if a PE ratio might not apply today. So I think maybe the final point I'll say is this is what makes tricky a lack of valuation. What also requires a higher level of diligence is often, of course, understanding these companies, right? A lot of them are in the business of selling something intangible, the world of high tech. And so it does take a sort of a greater degree of research and diligence. You just have to invest more time to understand often an esoteric industry and the nature of competition in it and the future for that industry. Ultimately, if you have the time to do some valuation work, try to understand what can revenues be in 5 years, what can margins be, and what can earnings be. And I think just as a very basic exercise, if a business today sounds great, but the valuation makes no sense, just ask yourself from your research, where can this business be in terms of sales in 5 years, a reasonable amount? How much profits can it make? Can it make 20, 30% profit margins? And then those profits in 5 years, could the valuation make sense on that number? And if that's still not working, then you're probably looking at something that may not make much sense at all.
Right. Thank you very much, Vitali, for helping us kind of unpack and understand what can be a very complex topic, and specifically when we're talking about the technology sector. Now we're going to head over to our live audience Q&A in just a quick moment. But before we do, let's reveal the answer to our trivia question we asked a little bit earlier. As a refresher, the question was, how many technology companies were among the 10 largest by market cap in the S&P 500 as of the end of June 2022? Do you have a guess, Vitali?
It might have been a little higher at December 31st, but I'm going to guess seven. Is it seven?
Wow, right on the nose. Okay, the
All
expert
right.
gets it right. There were actually 7 technology companies among the top 10 largest companies by market cap in the S&P 500 as of the end of June 2022. Apple took the top spot, followed by Microsoft and Alphabet, the parent company of Google. Well, I guess I'm not shocked that you got that one right. This is right in your wheelhouse. So good job.
Well, I was guessing actually. I was either 6, 7, or 8, but it is a sign of the times, and I think 30 years ago or so that of course was very different. And so maybe as a parting comment, that those companies are disproportionately what you're investing in if you buy generally the technology sector because of their size. And so as an exercise that's helpful if you're considering is the technology sector right for me or not, a lot of it is really looking at those 7, finding those 7, the Apples, the Alphabets, the Microsofts, and looking at their levels of profitability and asking yourself, hey, I'm using Google search today. This is the product of Google. Read their annual report and ask yourself, is this a business that I think can be enduring for the next decade or two? So those are, at the very basic level, the kind of the diligence investors here should start with.
Vitali, thank you again. Now let's head on over to our live Q&A and hear what the audience has to say. Thank you very much.
Thank you.